So there's a lot of noise about AI, but time's too tight for more promises. So let's talk about results. At IBM, we work with our employees to integrate technology right into the systems they need. Now, a global workforce of 300,000 can use AI to field their HR questions, resolving 94% of common questions. Not noise, proof of how we can help companies get smarter by putting AI where it actually pays off, deep in the work that moves the business. Let's create smarter business. IBM.
Everyone has been there. Your team's feedback is scattered across emails, chats, and sticky notes. It's a mess. But PDF Spaces and Adobe Acrobat gives you one collaborative workspace to streamline every file and comment. So, if you need 6 departments to finally agree on a proposal, do that with Acrobat. Need to turn a mountain of feedback into one plan of action? Do that with Acrobat. Want to stop searching for files and finally get everyone on the same page? Do that with Acrobat. Learn more at adobe.com/do that with Acrobat.
Here's a paradox. We buy insurance for peace of mind, yet the very policies we trust can deliver the biggest financial shocks. Across America, millions of claims are denied every year, not because people did anything wrong, but because policies quietly excluded the things that happened. The psychology of trust tells us we assume the contract is fair, but in insurance, the information gap is massive. The insurer knows every detail of what's covered. The policyholder rarely does. That's where My Policy Advocate comes in. For just 27 cents a day, their platform reads your policies and shows you in plain language where you're vulnerable. They're not selling insurance. They don't do that. It's about transparency, giving ordinary people the same understanding insurance companies have had for decades. Because when you know what's really in your policy, you can plan, protect, and avoid surprises. Before you trust your policy to protect you, let My Policy Advocate tell you what it really says. Visit mypolicyadvocate.com today. Peace of mind starts with knowing the truth. mypolicyadvocate.com.
Welcome to Inside Active, a podcast about active managers that goes beyond soundbites and headlines and looks deeper into their processes, challenges, and philosophies in security selection. I'm David Cohne. I lead mutual fund and active research at Bloomberg Intelligence. For years, ETFs were almost synonymous with passive investing. But one of the biggest shifts happening in the markets right now is the rise of active, particularly in fixed income, where inefficiencies, liquidity differences, and security selection can matter a lot more. At the same time, firms like Vanguard, historically synonymous with low-cost indexing, are leaning further into active strategies within the ETF wrapper, reflecting both investor behavior and portfolio construction are evolving. So today, we're going to unpack what's driving that shift across product design, investor behavior, and how active bond ETFs are actually being used. Joining me today as my guest is Jeff Johnson, head of fixed income product at Vanguard. Jeff, thanks for joining me.
Thanks, David. It's great to be here.
So let's start with the big picture. Vanguard, historically, known with indexing, what role do active fixed income ETFs play in Vanguard's broader product philosophy today?
That's a great place to start. And I think what I would say is that the conversation should still really start, in our view, with what is the role of bonds in an investor's portfolio and getting that allocation right. And, the appropriate allocation to bonds, of course, as we all know, really depends from investor to investor based on their time horizon, risk tolerance, goals, and a variety of other needs that are very specific to the investor. And from there, many investors, as we know, have a real preference for active investing in their portfolio, given the size of the fixed income market, the complexity of the fixed income market, the thousands of securities, the opportunities that present from the various inefficiencies that exist in the fixed income market. Now, for more than 40 years, Vanguard has been providing that exposure to investors in the form of actively managed mutual funds, which have very clearly served investors very, very well over the years. More recently, though, in recent decades, investors have increasingly shown a preference for ETFs. We first saw that really with the growth of ETFs in indexing oriented fixed income strategies, but more recently, that has come together in the form of a broader array of actively managed fixed income ETFs. So, from the standpoint of our investment philosophy, we're most concerned with getting investors the right allocation to fixed income first and foremost. And then from there, it really comes down to a choice and a preference between indexing or active, and then the vehicle that is most suitable to that particular investor, whether it be, traditionally a mutual fund or increasingly going forward an ETF.
So, how do you decide, if you're thinking from product design and product launches, which fixed income strategies belong in an ETF wrapper versus a mutual fund?
This is a timely question. As I said, our mutual fund lineup in fixed income goes back more than 40 years, and we still very much believe in those funds and strategies. They serve investors incredibly well. We have, on average, a 10 basis point weighted expense ratio across our lineup. That compares to 46 basis points for the industry. 88% of our funds have outperformed their peer group averages on a 10-year basis. So, we feel really great about the lineup. When we are thinking about new product development, though, increasingly over the last couple of years, and this is probably going to continue to be the case going forward, the real preference and the real demand for investors has been for an ETF. We saw that first with index products. We're seeing that increasingly now on the actively managed side. Actively managed ETFs pose certain unique challenges that we have to consider in the development and the design process that are somewhat different from the issues that we've faced over the years with mutual funds. One of them has to do with the transparency. An actively managed fixed income ETF discloses its full portfolio holdings on a daily basis. And what that means to us is, in an active strategy, it's really important to ensure that the same sort of, in some cases, proprietary strategies designed to generate alpha or outperformance can persist in an actively managed ETF despite providing daily holdings transparency and potentially signaling to the marketplace what kind of trading activity the portfolio management teams are up to. So that is one area in which, as we think about the design of actively managed fixed income ETFs, at times there are certain modifications that we have to make to the portfolio or the process to accommodate that and still ensure that we're delivering top-notch investment outcomes and the exposures that investors expect in a given strategy. Another aspect, and probably the second aspect that I would call out, that is really important for us to think about in active fixed income ETFs is size and scalability and capacity. At Vanguard, we're very proud to serve tens of millions of investors, but with that comes the obligation to really think about how scalable are these strategies going to be. It's sort of been a good problem to have in the past that we've had to, at times, close certain funds because we need to preserve the manager's underlying ability to generate alpha. And as you and your listeners would know, sometimes large cash flows or large size can be an impediment to generating the same sort of alpha that you have in the past. So anytime we're thinking about an actively managed product, we do have to think about how scalable it will be and ensure that we're not going to run into near-term capacity constraints.
Yeah, definitely something I like to think about a lot, when I'm looking at mutual funds versus ETFs. That's kind of like the big, I think of it more on the equity side, where capacity is an issue, but you're correct. The fixed income is also something to think about. And, Vanguard's launched several active fixed income ETFs in recent years. What gap in client portfolios were you trying to solve for and think about continuing to solve for going forward?
Yeah, I think of this not so much as a gap in client portfolios as an opportunity and a trend that it was time for Vanguard to participate in. Uh, you know, our first actively managed fixed income ETF was launched in 2021. That was the Vanguard Ultra Short Bond ETF. And a few years went by before we began to rapidly expand our lineup. And I think, in fact, David, one of your colleagues at times has liked to joke that uh, launching product at Vanguard is sort of like observing a lunar eclipse because it happens so rarely. And I think over the last few years, it's been fair to push back on that a little bit and maybe say that it's maybe more akin to like the cycle of a full moon, because we've been a little bit more active launching active products. We've launched 8 in the last 2.5 years. And that really came from a sort of a clear observance of a few trends coming together. One, we've long known that investors have a preference or a bias for being active in their fixed income portfolios. There's no doubt been a growth of indexing, but it is still an asset class where the opportunities are pretty abundant for very skilled active managers. The other trend that was pretty clear is the increasing preference for the ETF as a vehicle, and an ETF as the wrapper for the product. And as we saw these real trends converging and reflected on our deep expertise and capabilities managing ETFs, married with our more than 40 years of history managing active fixed income very successfully, we felt it was really time to bring the Vanguard effect to active fixed income ETFs. And as we set out on that journey, really had the opportunity to kind of blank slate, look at the market and say, all right, what kind of products, what kind of strategies are investors most gravitating towards? How have their needs evolved? And we've really concentrated our efforts in 2 areas. On the taxable fixed income side, there are a handful of very core building blocks that investors are increasingly utilizing in their portfolios when they show that preference for active management. They like short duration strategies to be able to minimize the exposure to changes in interest rates. So we launched a short duration core product. Investors continue to look for core and core plus fixed income strategies for those that are looking for an active alternative to an aggregate type benchmark, or an active alternative with some higher yielding sectors, like would be in the case in a core plus. We felt it was really important to offer investors exposures to active government securities. There are times when investors are more interested in yield, but there's also times when it really pays off to have that high quality, very liquid fixed income ballast in the portfolio, and we're offering that now in the form of a government active ETF. And then for those investors who are looking to go farther out on the risk spectrum, high yield and multi-sector can be strategies that offer more of that income focus. And then the second key category that we've seen is on the muni side, where we know that investors are very interested in controlling their tax obligations. And Vanguard has long been a leading provider of municipal bond funds. So offering a short duration and a core muni strategy, really, at least at this phase 1 of our product build out, really completes the steps.
That makes sense. We're seeing really strong growth in active ETFs across all asset classes. Why is fixed income in particular, in your opinion, such fertile ground for active management in this wrapper?
I think this gets back to something that we were describing earlier. The market is so broad. There are about 14,000 securities in the aggregate index. There are opportunities for skilled managers to uncover value with disciplined processes. There certainly are still cases in the fixed income markets where bonds are less liquid. It's long been said that certain types of bonds trade by appointment only. That is still the case, despite what's been phenomenal growth in terms of electronic trading and optimization and automation in fixed income markets. Another factor that we can't ignore here, though, is that ETFs is a relatively new technology still. I think for some investors, we're looking for ETFs to prove that they could withstand a crisis, for ETFs to prove that they could really weather a storm. And they really did so with flying colors in 2020. Again, in 2022, when we saw significant amounts of market volatility in both market environments, I think it really gave investors a lot of confidence that even though this is a vehicle where certain of the underlying securities can sometimes be less liquid, the liquidity of the overall wrapper has proven to be extremely effective. So I think that's given investors a lot of confidence and fueled substantial amounts of growth for fixed income ETFs.
Okay. Do you think active bond ETFs are gaining share because of performance, transparency, tax efficiency, or advisor adoption, or some combination of the previous ones?
Well, David, I think the answer is all of the above. I
Okay.
think investors are increasingly adopting active fixed income ETFs because they appreciate the transparency, they appreciate the liquidity, they appreciate the increasing array of choice that they have in terms of product design and offerings. I think, while active ETFs, still carry a slightly higher expense ratio than index ETFs by and large, active ETFs have come to the market at a bit more of an attractive price point than actively managed funds. More and more investors are really appreciating, what Vanguard has long espoused in terms of you really get what you don't pay for when it comes to investing, and the lower expense ratio means that you get to keep more of that return for yourself. The flexibility and the liquidity, again, those are just all features that investors are increasingly gravitating towards. And we really don't see that slowing down anytime soon.
So if we think from, I don't know, 5 years from now, what percentage of Vanguard's fixed income ETF assets do you think will be active?
Oh man, I would have a hard time putting a number on that figure. I think, when we look though at what we saw in 2025, that's probably fairly indicative of where the industry is headed. There were about $600 billion in flows into fixed income in 2025, and that was pretty evenly split between index and active. But roughly 70% of the flows were into ETFs. So it is increasingly the vehicle of choice. So I would expect our share of ETFs as in terms of Vanguard's overall fixed income book of business to continue to climb.
Okay. And if we think about right now, fixed income right now, where do you where are you seeing cash flow going in terms of the fixed income market? Ultra short, core, munis.
There have been some important shifts here over the last few years. I think kind of have to start the conversation in some ways with what happened in 2022 and 2023. Investors were very much, I think, startled by rapid moves in interest rates, inflation, and they saw declines on bond market benchmarks that they weren't accustomed to seeing. It had been, decades since they had seen those sorts of losses in fixed income. The good news there was, by and large, and Vanguard investors were very well behaved. I think we've always done a pretty good job of attracting investors who buy into our investment philosophy, our investment principles around, having clear goals, being balanced, being disciplined, focusing on low costs. So they took the volatility in stride. That all said, I think we saw a lot of the same trends that the rest of the industry saw, which was investors favoring shorter duration strategies, a lot of cash-oriented strategies. In recent years, and this was definitely the case in 2025, and it persists, investors have been creeping out the curve, and they've been looking to take on more risk and generate more income and yield in their portfolios, and the opportunity has really been ripe for that. So in the active fixed income category, a lot of demand for core plus, and multi-sector type strategies. And some of that speaks to the real appreciation that investors seem to have in active fixed income for entrusting very talented, skilled managers with the flexibility to move across sectors and identify value where their teams see the greatest amount of opportunity. And I would contrast that somewhat with what we see in index fixed income flows, which is probably more broad-based demand and in some cases investors looking for indices to target more narrow exposures and get their beta exposure that way.
So you think, things have changed since the rate shock of 2022, and you're seeing investors extending duration again.
We are seeing that. We're seeing them extend duration. We're seeing them look to, corporate and higher yielding sectors to pick up yield. I would remind them that the market environment is still one that is characterized by a great deal of uncertainty. There's certainly uncertainty from a geopolitical standpoint. We're going to be going through a transition of leadership at the Federal Reserve. Inflation is still very much on people's minds. The R word has crept in more recently as tensions in the Middle East have escalated. So, while we still see attractive opportunities in core plus and higher yield type sectors, but still remind investors that government bonds, inflation-linked bonds can play a real role in their portfolio from a diversification standpoint and can come in real handy if we do see periods of increased volatility.
What role do you think active bond ETFs are playing in model portfolios today compared to, I don't know, like 3 years ago?
Yeah, model portfolios are very much a growth engine, particularly in the financial advisor space. And models have been a driving force behind the adoption of fixed income indexing ETFs, in part because a lot of advisors are looking for very specific exposures to uh, sectors of the fixed income market, whether it's short duration, long duration, corporate, treasury, mortgages, high yield. So, indexed ETFs within model portfolios have been a very effective tool for advisors to be active with their asset allocation, but sometimes deploy those views in a passive way through an indexed vehicle. What we're seeing on the active ETF side, though, are the ability for advisors to build model portfolios that capture sort of the breadth of a team's best ideas in an active ETF. So we see, real growth for strategies in particular like core bond or core plus bond active ETFs, which tend to be a very strategic and core element of ETF models.
If we go beyond model portfolios and think of advisors that are doing, selection on their own, are you seeing them use active bond ETFs differently than index bond ETFs?
There's some nuanced differences here. And as we've kind of talked about a little bit already or alluded to, I think it's long been the case that investors have a bias in fixed income towards being active because of the opportunities and the inefficiencies and the breadth and complexity of the market. And it was only just in 2025 that index flows were about on par with active flows across the industry. For 25 years, I've been in and around fixed income markets, spoken to a lot of investors, spoken to a lot of clients. I haven't met too many fixed income investors who are purely passive. Most fixed income investors are active at a minimum when it comes to setting the asset allocation. They're thinking about what are their unique goals, what's their time horizon, how important is liquidity in their portfolio, how comfortable are they going down the credit quality spectrum and picking up additional yield? Are taxes important to them or not? These are all very, very active decisions that a fixed income asset allocator must make when building their portfolio. And the great news for them that's emerged over the last 10 years or so is that they have an incredible amount of choice now. If they want to be very active with that decision making from an asset allocation standpoint, they have an abundance of tools that allow them to position a portfolio and deploy their views actively, but potentially using underlying index vehicles that track those benchmarks that reflect their active points of view. In other cases, we continue to see fixed income investors looking to active managers to scan the universe and look for the best opportunities, capitalize on the value that's available. And increasingly, what we're seeing is that they're showing a preference in active vehicles towards the broader, more flexible fixed income strategies that give the managers the latitude to move across investment grade or high yield or emerging markets, or in some cases currencies, maybe mortgages, securitized sectors to find the best value wherever it exists at that point in time.
So I kind of want to go a little deeper. Yields are obviously meaningful higher than they were, I don't know, like a decade ago. Do you think the conversation's changed about, taking credit risk for, whether it's advisors or individual investors?
Well, you're right. Yields are higher, and higher yields have changed the conversation a little bit that we're able to have with investors. It wasn't too long ago that investors were, pretty pretty bothered by the very low yield environment. There wasn't a lot of income available. That has no doubt changed. It's changed so much, in fact, that Vanguard's own longer term economic outlook has fairly comparable expected returns between stocks and bonds. This is an environment where we think investors at least need to be thinking about a 60-40 portfolio, if not 40-60. And that's especially the case in a market environment like we have today, when there is, a great deal of uncertainty and we've seen increases in volatility. Some investors are still nervous about what could happen if rates rise or if you do get an inflation shock. But the good news is that when you have a core strategy that's yielding upwards of 4%, you do have a built-in yield cushion, so that if yields do go up from here, the good news is that you're going to be earning higher yields from here. The other good news is that, that higher yield that you're starting out with provides a little bit of a buffer from any sort of capital losses that take place in the shorter term.
So the fixed income ETF ecosystem is evolved pretty rapidly. How do you think about liquidity in active bond ETFs, especially in less liquid sectors?
Uh, really, we think about it very similarly as we do thinking about liquidity in our actively managed fixed income mutual funds. These are all broadly diversified strategies. We have a liquidity framework and a toolkit for all of our active strategies. We're very disciplined about maintaining dry powder in these portfolios to help ensure that the managers always have the flexibility to take advantage of opportunities when the market presents them. I think the experience that Vanguard has going back decades managing ETFs on the index side has allowed us to build out years and years of technology and expertise and experience through different cycles, managing ETFs, developing that ecosystem, developing a capital markets ecosystem. I think this combination of our active history, our index history, and our ETF history kind of provides a unique combination and value proposition to investors looking for kind of the best of all of those things in active fixed income ETFs.
Okay. And what differentiates Vanguard's approach to active fixed income ETFs from peers who may want to emphasize things like higher yield or more tactical positioning?
Sure. Uh, you know, for 40 years, for more than 40 years, Vanguard has been managing active fixed income, according to, a few key principles. Number one, it really starts with having a deep bench of experts, with more than $2.5 trillion in fixed income assets under management, and more than 200 fixed income investment professionals globally. There's just no question that you need a deep and experienced and talented team to manage this market. Another component of our approach that we're proud of and that is differentiated in the marketplace is that it's very much a team-oriented approach. You won't hear us talk a lot about star portfolio managers. Doesn't mean that we don't have stars on the team. I think we think of all of our PMs as being all stars and a team of stars. But this team-based approach, this highly collaborative approach, really allows us to share the best insights and the best ideas across all of our portfolios.
Great.
I think a third aspect of the strategy is really just the consistency and having a repeatable and durable process. And what's most important there is focusing on the most repeatable sources of alpha generation. And for us, that really starts with security selection being repeatable and reliable and durable through different market cycles, more so than timing rates increasing or decreasing the duration. So that allows us to have very consistent investment outcomes. And then finally, I think we couldn't be talking about the Vanguard offer without the cost advantage. Our low costs combined with the repeatable process and the deep and talented team means that investors get to keep more of what the market is providing them. And that's just such an important dynamic in fixed income where, in general, over time, you're talking about an asset class that's going to have a lower expected return than others like equities traditionally, or maybe even private investments for those investors who are going to incorporate those in their portfolios. So being able to keep more of what they earn has been an important engine behind 88% of Vanguard's fixed income funds outperforming their peer averages over 10-year periods of time.
Well, it certainly seems like active fixed income ETFs is going to be a big growth area for your firm. And, I'm looking forward to seeing what's next. But unfortunately, we need to end here. But this was great, Jeff. Thanks again for joining me.
Anytime. Thanks, David. Always a pleasure.
I also want to thank our listeners. If you liked the episode, please share it, subscribe, and leave a review. And if you'd like to see more of our research on the terminal, go to BI Fund Go for fund and active research. Until our next episode, this is David Cohne with Inside Active.
Here's a paradox. We buy insurance for peace of mind, yet the very policies we trust can deliver the biggest financial shocks. Across America, millions of claims are denied every year, not because people did anything wrong, but because policies quietly excluded the things that happened. The psychology of trust tells us we assume the contract is fair, but in insurance, the information gap is massive. The insurer knows every detail of what's covered. The policyholder rarely does. That's where My Policy Advocate comes in. For just 27 cents a day, their platform reads your policies and shows you in plain language where you're vulnerable. They're not selling insurance. They don't do that. It's about transparency, giving ordinary people the same understanding insurance companies have had for decades. Because when you know what's really in your policy, you can plan, protect, and avoid surprises. Before you trust your policy to protect you, let My Policy Advocate tell you what it really says. Visit mypolicyadvocate.com today. Peace of mind starts with knowing the truth. mypolicyadvocate.com.
These days, it seems like AI agents are just about everywhere you turn, every field and every function. But without identity, you can't trust they'll serve your business instead of jeopardizing it. Fortunately, Okta helps you get identity right by securing your AI agents' identities, giving you a single layer of control, a single standard of trust. So whether an AI agent supports a single user or your entire enterprise, with Okta, you'll turn risk into opportunity. Secure every agent. Secure any agent. Okta secures AI.
Travel smarter, not harder, at America's Best Value Inn by Sonesta. With convenient locations from coast to coast and value pack comfort at every turn. It's a practical choice for road trips, quick getaways, and everyday travel that keeps things simple without sacrificing comfort. And when you're a Sonesta Travel Pass member, staying at America's Best Value Inn means earning points toward free nights, upgrades, and more every time you stay. Go to Sonesta.com to book your stay and unlock the best rates with Sonesta Travel Pass. Here today, roam tomorrow. Join now at Sonesta.com. Terms and conditions apply.